In my last video, I asked you whether you want to see me code a trading algorithm in Python from scratch. The overwhelming majority of you wanted to see me do this, so that's exactly what I'm going to do in this video. To create this trading algorithm, I will be using the QuantConnect platform, which is a great algorithmic trading platform with lots of great features, and besides that, it is free to use. So if you want to code along, make sure to quickly create a free account before watching this video. There's a link in the description box below. With that being said, let's get started with creating our first trading bot. But before we start actually implementing our algorithm, we must first develop a trading strategy on a conceptual level. For this video, we're going to try to implement a simple breakout strategy. This strategy will look at the past highs of a given instrument and generate a buy signal as soon as the price manages to break out from its previous high. After buying the security, we'll want to send out a trading stop loss that follows the price upwards. As long as the price continues to rise, our stop loss will do so as well. But as soon as it drops more than a certain amount, the position will be closed. The idea behind this trading stop loss is to cut our losers short and let the winners run. When developing trading algorithms, it is very important to be very precise with what you want. Identifying when a significant price breakout occurs might be very easy for us, but it isn't necessarily obvious for a bot. If, for instance, we look at this chart, there are many potential breakout levels. Unlike humans, an algorithm can't just use its judgment to determine which level is the best. Therefore, we have to specify how a breakout is defined for our strategy to work. The easiest approach for this would be to say that we look at the closing prices for the last 3 months, and whatever price is the highest is our breakout level. But here the question arises of why do we look at 3 months? Why not 1 month or 1 year or some other time frame? That's why we don't just want to pick some random number as our lookback length. Instead, we want our algorithm to dynamically determine how far it looks back for a breakout level based on the security's volatility. If volatility is high, we want it to look further into the past than when volatility is relatively low. By doing this, the algorithm will automatically adapt to changes in volatility. So to quickly recap, the strategy that we're going to implement is a simple breakout strategy that dynamically changes its lookback length. Furthermore, it uses a trading stop loss to protect against potential losses. With that being said, let's head over to the QuantConnect platform and actually start writing some code. In the QuantConnect platform, we click on Create New Algorithm, which brings up a bunch of modules as well as a basic template algorithm. These modules are all part of the algorithm framework, and they allow you to use pre-built parts of code that can be helpful for certain trading strategies. If you want to learn more about the algorithm framework, you could check out my video about how trading algorithms work. In this video, we won't be using any of these modules since our algorithm is fairly simple. By default, you will now see your algorithm as an extension of the QuantConnect algorithm class. Furthermore, you will see the initialize and OnData methods. Like the name implies, the initialize method exists to initialize various parameters, variables, and other settings. For instance, this is where we can initialize the starting capital, start date, and end date for our backtests, but more on that in a minute. Before we do anything else, let's import numpy as np, since we will later need numpy to calculate the standard deviation for the volatility adjusted lookback length. After doing that, let's start with the initialize method. For this, let's clear out everything and start with a blank method. Firstly, we will set our starting cash balance. This is obviously only for backtesting purposes. In real trading, this figure will be taken from your broker's account balance. For this example, let's just use 100,000 as a starting balance. Next up, let's set the start and end date for the backtests. For now, it really doesn't matter what we choose here. Just make sure to leave enough data untouched so that you have some data to test your algo on without overfitting it. Now we will add an asset to our algorithm. This will be the security that we're actually going to use for trading. To do this, we're going to use the addEquity function. The first parameter is the symbol of the equity that we want to add, and the second parameter is the resolution of the data. We're going to use daily data for now, but it is also possible to use hourly or minutely data. As for the security, we will use the ETF SPY that tracks the S&P 500 index, but feel free to use other securities. The next step is to initialize the number of days that we will look back to determine the breakout point. You hopefully remember that our algorithm will dynamically change this lookback length based on changes in volatility. That's why it isn't that important what value we choose here. Even though we want our algo to dynamically change the lookback length, we also want to add some constraints. We don't want the lookback length to get too big or too small. That's why I will add an upper and lower limit. For now, I will choose 10 days as a lower limit and 30 days as an upper limit. This choice isn't really based on anything though, so you could definitely try different values if you want to. The last two variables that we want to initialize are relevant for our trailing stop loss. The first variable, self.initialStopRisk, indicates how close our first stop loss will be to the security's price. So 0.98 means that our first stop loss will allow for a 2% loss before it gets hit. The next variable, self.trailingStopRisk, indicates how close our trailing stop will follow the asset's price. Here I chose 0.9, which means that it will trail the price by 10%. I know this is quite large, but we want to give the price enough room to move in since we otherwise might get stopped out at every short-term reversal. Note that the values 0.98 and 0.9 are quite arbitrary choices. You could definitely use other values for these variables if you want to. Next up, let's quickly talk about the OnData method. The OnData method is called every time your algorithm receives new data. This method can then decide what to do with the data and if any action should be taken. Instead of using the OnData method for any trading, we will create our own method since this gives us even more freedom. But we will use the OnData method to create a plot of the price of the security that we are trading, since this gives us a benchmark to compare our algorithm's performance to. This can be done with self.plot, which takes 3 arguments. The first is the name of the chart that we want to create, the second is the name of this plot on this chart, and the last is the actual data for the plot. We will call the chart data chart, and the plot will just be the symbol of our security. In this case, this will be SPY. And finally, the data will just be our security's closing price. Now, let us create a method that actually does all the trading for us. We will name it every market open, since we will want it to be called after every market open. To accomplish this, we will have to add one last thing to our initialize method, namely the schedule_on function, which takes 3 parameters. The first specifies on which days our method is called. We want it to be called every day that our security trades. The next parameter specifies at which time our method is called. We want it to be called 20 minutes after our securities market open. And last but not least, we specify which method is called, namely our every market open method. If you aren't sure how many arguments a function takes or what type the arguments are, you can search for it in the top left corner. This will bring you to the documentation page, which explains how everything works and often provides helpful examples. Now that we have initialized everything, let's implement our every market open method. First, we need to determine the lookback length for our breakout. To do this, we will look at 30-day volatility today and compare it with the same value yesterday. We will then use this information to adjust the length of our lookback window. For this, we first need the closing prices of our security over the past 31 days. This can be accomplished by calling the history method. This returns a data frame with the close, high, low, and open price as well as the volume for each day over the past 31 days. We are only interested in the close price though. To calculate the volatility, we take the standard deviation of the closing prices over the past 30 days. This is where we use the numpy standard deviation function np.std. First, we do this for the current day and then we do it for the day before that. Then we take the normalized difference of these two by subtracting yesterday's value from today's and then dividing by today's value. Now we multiply the current lookback length by delta vol plus 1. This ensures that our lookback length increases when volatility increases and vice versa. Since our lookback variable is the number of days, it has to be an integer. Therefore, we round our result to the nearest integer. Next up, we check if the resulting lookback length is within our previously defined upper and lower limits. If it isn't, we make sure it is, and otherwise we do nothing. The next task is to check whether a breakout is happening. For this, we once again call the history function to get a list of all daily price highs from the period within our lookback length. We save this list in the variable self.high. Before we open any position, we have to check two conditions. The first is that we aren't currently already invested, and the second is that a breakout is actually happening. To check that we aren't invested in our symbol already, we can use securities.invested. The second condition can be checked by looking at the last closing price and checking whether it is higher than the highest high from our self.high variable. Note that we leave out the last data point of our self.high list since we don't want to compare yesterday's high with yesterday's close. If these two conditions are met, we want to buy SPY at the market price. The easiest way to accomplish this is by using the set holdings method. The first parameter of set holdings is the security that we want to trade, and the second parameter is the percentage of our portfolio that should be allocated to this position. Since the algorithm won't be trading any other securities, we will set the holdings to 100%. Before moving on, we save the breakout level to the variable self.breakoutLevel. Furthermore, we will set the variable self.highestPrice to this breakout level. We will use this variable for our trailing stop loss in a minute. Now, all that's left to do is implement the trailing stop loss. The trailing stop loss is only relevant when we already have an open position. Therefore, we first have to check this condition. Just like before, we can do this with self.securities.invested. Next up, we want to send out a stop loss if we haven't done so already. So we check if there are any open orders with self.transactions.getOpenOrders, which returns a collection of open orders for our security. If the collection is empty, the if condition is fulfilled. In that case, we send a stop loss order by using self.stopMarketOrder, which takes 3 arguments. The first one is the symbol of the security that we want to trade, the second one is the number of shares, and the last argument is the stop loss price. In our case, we want a stop loss for our entire position, which is why we use portfolio.quantity to find out how many shares we own. Note that the minus symbolizes a sell order. For the stop loss price, we multiply the breakout level by self.initialStopRisk, which we initialized to 0.98 earlier. This gives us a risk of about 2%. But note that this number is a relatively arbitrary choice and can easily be changed. Now we have implemented the code that sends out the actual stop loss order. All that's missing now is the part that turns this stop loss into a trailing stop loss. To turn it into a trailing stop loss, we save our stop loss into the variable self.stopMarketTicket so that we can access it later. Every time our security makes new highs, we want our stop loss to rise as well. If the price does not make any new highs, we don't want our stop loss to move. That's why we use this if statement to determine whether a new high was made. Furthermore, we don't want our trading stop loss to move below our initial stop loss price. Therefore, we also have to test this condition before moving on. If these two conditions are met, we first set the highest price to the latest closing price, since this now is the new highest price. We then create an update order fields object and save it to the variable update fields. We will use this object to update the order price of our stop loss so that it rises together with the security's price. We calculate the new price by multiplying our trailing stop risk level that we initialize to 0.9 by the latest closing price. Then we update our existing stop loss order with the update method. Lastly, we want to print this new stop price to the console so that we can check the new order price every time they get updated. Here we can't just use the normal print function though. Instead we have to use self.debug, which is QuantConnect's equivalent to print. Outside of the if condition, we also want to plot the stop price of our position onto the data chart that we created earlier. Doing so allows us to view where our stop loss is compared to the security's trading price. We call this new plot stop price. To get the necessary stop loss data, we use self.stopmarketticket.get with orderfield.stopprice as an argument. Now that we have done this, we have successfully written our first trading algorithm. All that's left to do now is build and backtest it. Earlier we specified the backtest period from September 2017 to September 2020, but feel free to try out different time periods if you want to. To backtest our algorithm, we simply have to click the backtest button up here, and then we have to wait for the backtest to finish up. When the backtest is finished, a performance overview will be generated. At the top of this report you can see some of the most relevant stats, such as realized and unrealized gains, returns, fees and more. Even though it's nice to see a big profit up here, you shouldn't put too much weight on these results. Depending on what time frame you choose for your backtests, these figures can be very different. Nevertheless, it is nice to see that our algorithm managed to generate a profit over the chosen time frame. Right below this bar we can view an equity chart of our portfolio. This is a great way for us to quickly see how our returns were distributed. Otherwise, there also are some other charts and metrics that can be helpful when analyzing your algorithm's performance. At the top right, you can select which chart should be displayed. Let's quickly look at the data chart, which is the custom chart we created for our algo. As you can see, it plots both SPY's price as well as the price of our trailing stop orders. In my opinion, this is a great way to see where our strategy performed well and where it didn't. Otherwise, you might also notice this research guide on the right hand side. This tells us how often we have backtested our algorithm, how many parameters it has, and how much time we have spent on it. These metrics can give you an indication for how overfit your algorithm potentially is. So generally speaking, fewer backtests and parameters are better than many. In this algorithm, an example of a parameter is the upper and lower limit for our lookback length, or the risk percentage for our stop loss. Instead of having some arbitrary number, you could have a more dynamic approach in which the algorithm calculates its own optimal values. Such an adaptive and dynamic algorithm will usually be less prone for overfitting since it can adapt for changing market conditions. If we scroll down further, we also get an overview of some other helpful metrics. Here we can see that our algorithm made 9 trades over these 3 years. It had a win rate of 50%, but the average win was much bigger than the average loss. A very helpful metric to look at is the Sharpe ratio, which measures the return compared to the risk that was taken. The higher this ratio is, the better. For our algorithm, the Sharpe ratio over the chosen time frame is about 1, which isn't too bad. But once again, I want to emphasize that all these metrics are only for the exact period that we chose to backtest. They can be significantly different and worse over other time periods. Lastly, you can click on the console at the bottom of the page to view what the algorithm printed. If you remember, our algorithm printed the stop price of its trailing stop every time the price got updated. As you can see, all these prices can be seen here. When backtesting, this doesn't seem too helpful, but when fixing bugs or in live trading, it can sometimes be very handy to print certain things to the console. Before I end this video, I want to present to you how you can become an algorithmic trader yourself. I really hope that this video gave you a good overview of the algorithm development process, but I don't expect you to be able to easily code your own algorithms without any help after watching one video. If that's your expectation, you're setting yourself up for disappointment. Just like with coding and most other skills, the best way to get better is by practicing it yourself. If you haven't used QuantConnect before, they offer a great free bootcamp that walks you through a bunch of other trading algorithms. In my opinion, this is a great way to get more into algorithmic trading and the QuantConnect platform if you already know how to code in Python. Otherwise, you can try to come up with really simple strategy ideas and then try to implement them with the help of QuantConnect's documentation, community posts, and more. If you want to, you can even copy my algorithm and try to improve it. A few aspects that could be improved would be to add dynamic position sizing, add a universe of stocks instead of just having one, make it more active, or you could try to make it more dynamic by replacing parameters with other models. In general, if you want to play around with the algorithm from this video, there's a link in the description box below that allows you to copy the code. I just wouldn't recommend using this algorithm for live trading since it's not very well polished nor very well researched. The main purpose of this algo was simply to give you an introduction to algorithmic trading and the QuantConnect platform. With that being said, I really hope you enjoyed this video and learned something new. If you want me to create more videos in which I develop and implement trading algorithms like this one, definitely let me know by liking the video and leaving a comment below. Otherwise, make sure to subscribe and turn on the notification bell for more content like this. Thanks for watching.